And we have Pathik Gandotra, partner at Dron Capital Advisors, as well as Gurmeet Chadha, managing partner and CIO at Complete Circle, who join us in the conversation. Hi, gentlemen. Thanks a lot for joining in. Pathik, let's come across to you first. What do you make of what you heard from President Trump overnight? The tariffs now have been announced. All eyes on whether or not there is some renegotiation and negotiation. But how are you placed currently? What would you do? For the time being, we're celebrating that the Indian markets have done a relative outperformance. But are we calling it too early?
The Indian markets are obviously outperforming because we have been better placed on a relative basis vis-a-vis all our competitors. China is anyway, I think, out of the race because it has issues other than just trade with the US. And with the other near-term competitors in various sectors, you find that India has had a relatively lower tariff. Second point, it appears that these tariffs are based on not absolute duties, but absolute quantum of trade deficit. And so given the fact that, say, countries like Vietnam, Bangladesh, etc., smaller countries which compete in some of our sectors, apparel, say, for example, they will not be able to bridge this gap on a sustainable basis because they physically can't do it, whereas India can. And so we have a chance to build on these duties and to try and reduce these duties on us and are at an advantage on an absolute basis right now. And also going forward, we can have a stronger advantage over them. And so obviously, I think we are at a very, very significant advantage. You may have obviously near-term issues about a sudden increase in tariffs, obviously hits contracts as they are live. So there may be some volatility in margins, etc. But overall, I think it's a great opportunity for India to at least significantly improve its share in the worldwide in the labor-intensive sectors.
Gurmeet Chadha, Managing Partner and CIO at Complete Circle, is also with us on the show. Gentlemen, afternoon. Gurmeet, what have you done today? There's not been too much volatility, surprising, but have you made any trades?
Not much, Rima, to be honest. I think I think you have probably seen the second leg of this. You can probably divide it into 4 parts. I think the third leg would be when the negotiation starts, and if they don't do, retaliation happens. We'll have to see how China does, how Europe does, and there's that clause 4 in the executive order where a lot of countries will try and negotiate back in terms of the relative tariffs. So for now, I think pharma clearly stands out. I think that's been exempted, but you don't know how things pan out. So I think we've added a little bit of branded pharma. We added some CDMO names in the portfolio. We have Mankind Pharma, we have Laurus, we have Newland and Hikal. So we have a decent healthcare portfolio, and we have been overweight on it for a while. So that's helped us. We are continuously looking at more domestic consumption stories right now. I think banks will gain with bond yields falling, treasury incomes going up. That will offset the NIM pressure. And then you have an RBI policy on 9th as well. So Bank Nifty obviously has also done well from relative lows. And we are looking at some travel tourism plays. So we are right now adding domestic consumption and bit of financials and pharma. And wait out for 4 or 5 days. I agree there could be some opportunities which will come because the relative tariff on Asian peers is far higher. And if India is able to negotiate well over the next 4 or 5 days, a lot of opportunities may emerge. But for now, just wait it out for 3 or 4 days, 1 day at a time.
Absolutely. I mean, that's exactly what Sameer was also saying, that there's no need to fire the gun immediately. Sit back, observe, see what's going on, and then decide what's the best course of action. Take your point, Gurmeet. By the way, let's look at some of the textile stocks, and they're soaring. They're doing really well in trade today. Arvind, Gokuldas, and Trident. And if you'd wonder why, given the 27% tariff on India, that's because others have been taxed a lot more. Our major competitors in textile and apparel, which would be Bangladesh, Vietnam, and countries like Sri Lanka. So let's go across to, I think, Vinny. Vinny is now standing by to give us a better perspective on whether Indian textile makers actually stand to gain. Vinny.
So absolutely, when you look at it in terms of a tariff that's charged on India, 27%, it seems like a lot. But versus the other countries that we're seeing, whether our main competitors, Bangladesh, China, even Turkey, Japan, Taiwan, the percent that is charged to them is much higher. So yes, versus the other countries, we are charged much less, and that turns out to be a bit of a benefit for all these companies and exporters in India. Now, we had a note that came in from Prabhudas Leela this morning as well. They said this tariff will actually give an edge and an opening for India in terms of an opportunity in the US market, because other countries would become much more expensive. Currently, in terms of textile exports as well, the shipments that are made to the US is totaling to around $2.8 billion in FY24, and the share of US apparel imports for India as a import country is very less. India is just 6%. When you look at China, 20+%. Vietnam around 20% as well, and Bangladesh is around 9%. So yes, our share in the apparels is also very less in the US market. So not much of an impact that comes in for us, but it becomes an opportunity, because then they would want to increase the share. The 6% could further increase as an opportunity versus China, Vietnam and Bangladesh. Now, other than that, what Prabhudas Leela is highlighting is that Indian exporters, a relief tariff advantage would come in, enhancing the competitiveness by around 10 to 20 percentage points for the Indian players in the industry. Arvind Limited, when we spoke to them earlier as well, they said that they expect these new trade agreements that are going on in the market in US and UK to be a bit of a benefit. Bilateral trade agreements will come in. That is more exciting for Indian textile industry, as well as the Indian textile industry will now look at a more holistic approach, especially for the Western market. So positive cues that are coming in for the textile front, despite this 27% tariff.
Got it, Vinny. Thank you very much for that. Let's take this conversation back to our guests. Pathik and maybe Gurmeet, I mean, if either of you or both of you can comment on this. Textiles and apparel as a space, I mean, these stocks have not dominated market imagination for obvious reasons. Individually, yes, these companies have been doing well. Gokuldas has been one of the biggest exporters for a long time. But perhaps it was a bit of an opportunity lost in the last 20 years, because other countries, were way ahead of us in the race. So now, is it a case to relook at some of these mid-cap or even small-cap textile and apparel exporters? Gurmeet?
So, I think we should wait for the end consumer demand in US to pan out. While relative tariffs are lower, but if the end demand, sees a slowdown, it won't affect. So Gokuldas is more uniquely placed because 80% is US exports, and they also acquired one plant in Kenya about 6 months back, where the tariff is 10%. So there, the effective tariff for their acquisition, they did one in Middle East, and now, would be relatively lesser than even, let's say, whatever the rate is, which is around 25-26%. So that's an advantage. KPR Mills also, to a certain extent, is fully integrated. So you have to be a little selective here as far as, textile goes. So if you see, for example, Vietnam is 46%. Even Thailand, Indonesia are mid-30s. Bangladesh is pretty high. Bangladesh was something where India and Gokuldas competed on a lot of things. Gokuldas does these labels called Superdry, Adidas, Puma, the Merchant Navy, Indian Navy brand in US. So I think Gokuldas in particular, post the change in management, has done well. But I would wait out for, if the US economy, let's say, broadly goes into a hard landing or a recession, then these things don't really add up. It could be right now more a reaction, more to do with the positioning of the stocks rather than anything else.
Yeah, I guess that's why they say that ultimately you cannot take away that big line, right? When the US catches, or when the US sneezes, the rest of the world catches a cold. So while there could be an opportunity, if US consumers aren't buying, then really what are we talking about? Got that point. On pharma specifically, Pathik, what would your call be? Would you still be wary of companies that have a big exposure to the US market? Or are you happy to own those names, who are far more dependent on the US sales?
I'd like to add to Gurmeet's point. Just one point I want to add before I comment on pharma. See, the US demand, I guess, obviously will be optically, it looks like will get impacted because of the tariffs. But also remember that the president has said that he will cut taxes across the board. And numbers of around $400 to $500 billion in tax cuts is what they are thinking about. So if those tax cuts come, it's like you populate one pocket and take it out of the other pocket. And so all those things are also material to figure out as to what demand will be. And I agree, you have to wait. But the picture isn't as sordid as it appears. That's my point on April. Second, pharma, I think, given the fact of the criticality of the of medicine, and also the fact that there are not too much of capacities which are coming up in the US, I think the pharma sector will be dealt with leniently over a period of time. So I would go out and look at decent companies in the CDMO space, and I would agree with Gurmeet as to what he said, that look for good quality names in the CDMO space, which have firm contracts with large majors, and those would be very interesting. I would not obviously go for just normal exporters because who just export generics. I think CDMO is a more preferred space.
Pathik, Sameer was just telling us that he will absolutely stay away from the Indian IT space. In your portfolio, do you own Indian IT? And now what would the approach be?
No, I don't own any IT. Absolutely zero.
All right. And the advice would be continue to stay away.
Yeah, I mean, we look at, actually, it's not about specifically about the IT sector at this point in time. We do look at companies from time to time. We are bottom-up focused. We don't mirror the indices or anything. We don't look at large companies in any case. And so, I mean, that I'm not the right person to answer the question.
Okay, all right. We'll leave things there. Gentlemen, thank you very much. We'll have, this is, I'm assuming, the first of many conversations, and the word tariff isn't going anywhere as much as we like it to be. So thank you very much. Gurmeet and Pathik, appreciate your time here on CNBC TV18. Just about 30 minutes to go, 28 to go for the market close, last 30 minutes.